we've seen great progress in economic activity. There certainly have been some pauses along the way, including here in Canada through lockdowns in April and May. But overall, labor markets, consumption, and business activity all have strengthened significantly in recent months. And this has been supported by increased vaccination rates around the globe, although certainly with differences across regions and countries. Of course, ongoing progress around vaccinations is a necessary condition for a broader global economic reopening and recovery. And it's especially important in countries where there has been less room for fiscal stimulus to offset the economic impact of lockdowns. But regardless, the progress in economic activity has supported equity markets globally, with the number of major indices posting double-digit returns year to date. Canadian equities, as well as the Canadian dollar, have shown particular strength, supported by a remarkable recovery in the energy sector. There has certainly been some volatility along the way. One of the areas that the market is watching very closely is inflation. For now, there seems to be fairly broad consensus across market participants that current elevated inflation will likely be temporary, in part driven by unusual year-over-year comparisons, as well as supply bottlenecks during the uneven reopening across the globe. Regardless, this will continue to be an important area to monitor over the coming months. In particular, we'd want to keep a close eye on the US Fed's view on unemployment and inflation to understand how perception of monetary policy may evolve over the coming months. And more broadly, it will be helpful to look at how monetary conditions and liquidity evolve globally alongside. An important question in this regard is how it may impact monetary policy or perhaps expectations around it over the coming months. In the US, the Federal Reserve conducts monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the US economy. If inflation expectations rise or perhaps become more persistent, market participants may anticipate reduced support from the US Fed. And this in turn may push up short-term interest rates or potentially make interest rates more volatile, and in turn may trigger some volatility in equity markets. So we may see more differentiation as we look ahead. Looking back, leadership between growth and value styles has been an important topic. As we look ahead, it may be helpful to also consider quality, for example, as a factor in equity allocation.